under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now, too. So it's partly that consumer spending has held up. It's been resilient. And to another degree, it is that spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment in the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time, so it's basically a good thing, but that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against a cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the 2 parts of the mandate, and when you do, this is what you see, and I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful. respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're going to look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did 2 discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the notwithstanding the 150 basis points in cuts prior to today.
So I think the idea is that with now having cut 75 basis points more now, and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
And just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. that is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant, as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20–25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we don't think that we help matters by trying to engage as a public discussion of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
No, just one more.
I guess I wanted to come back to the 1990s question, and do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you you've got to, and I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say. And that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, there's the announcement of a tariff, and then there's, they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the, it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
Mike,
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got to, when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very, that's one part of it is inflation compensation break-evens. And, they're at very comfortable levels. They're at levels consistent. Once you get out past the very short term now, break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation, as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive, so nominal wages are higher than inflation, for people to start feeling good about affordability, the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria.
Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But, it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and, we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market, because the labor market unemployment was very low. If you remember when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability, and the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth.
Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing. And it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20. And, that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way, that's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance, and since job creation, job finding rates are extremely low. If there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much. So it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Enda.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
the policy what? On
the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine.
Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a price stability and a strong labor market. And what we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and got the really low. So it's made it expensive for them to move. And we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time, and so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Chris.
Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods. And we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? That's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think, again, all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's I don't have time to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Chairman Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked, while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave, sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so all of us who work in economics jobs are really fortunate to have the U.S. economy. So thank you very much.
Good morning. It's an honor to be with you today. Unfortunately, the government is still shut down because members of the Senate refused to support the Clean Government Funding Bill, which was passed by the House weeks ago. Across the Trump administration, we are eager to get the government reopened so agencies can continue to work for the American people. Glad to see all of you were able to continue your work today. This morning, I wish to focus on how we can better serve the American people and the important role community banks play in that effort. To begin, I'd like to express my appreciation to Vice Chair Bowman for arranging this conference. She and I are committed to protecting the role of community banks in our financial system. This conference is a testament to that commitment. As you all know, better than most, regulation has gradually suffocated the banks that are closest to the men and women who work the jobs, pay the bills, and take out the loans that fuel growth in small-town America. Banks that not only know their customers by name, but also their financial hopes and dreams. In other words, banks like yours. To reverse course, earlier this year, I called for a fundamental reset of financial regulation. No longer will regulation serve to entrench big banks and empower Washington bureaucrats to the detriment of community banks and the clients they serve. President Trump and this administration have charted a new course for our economy, one that strengthens both the shop floor and the trading floor. This is what I call the era of parallel prosperity, where Main Street and Wall Street grow together. Who will turn this vision into reality? The men and women in this room. Community bankers are laying the foundation for America's golden age, one loan, one family, and one small business at a time. My job as Treasury Secretary is to make it easier for you to do your job, To that end, we have worked hard for the first 8 months of this administration to empower community banks to take back control of their own future. This morning, I will discuss why the Trump administration has sought to empower community banks, how we have done it, and where we will go from here. First, why? Community banks are essential to America's heartland. They provide the capital that binds small towns together. Community banks make the charitable contribution for the new playground. They make the loans for small businesses, farmers, and first-time homebuyers. They employ local leaders and teach financial literacy in our schools. Parallel prosperity, as I mentioned before, is the idea that Main Street and Wall Street can grow together, and community banks play an instrumental role in driving growth on the Main Street side of the ledger. To expand opportunities for all Americans, the banks that serve Main Street must have the same chance to succeed as the banks that serve Wall Street. But the post-crisis regulatory framework has instead become a threat to the community bank model. Since 2010, we've lost 3,600 community banks, a reduction of over 45%. Community bank share of bank assets have fallen from 23% to 15%. Their share of outstanding bank loans has fallen from 27% to 20%. Their share of outstanding bank CRE loans has fallen from 52% to 41%. This represents an acceleration of trends that predate the 2008 financial crisis. And in a disturbing new development, de novo chartering has dropped precipitously, averaging just 6 new banks per year since 2010. For comparison, in the years prior to 2008, there were 100+ new banks chartered each year. The post-crisis framework has left a trail of destruction in its wake by reinforcing the larger economic dynamics that have hollowed out the American heartland while enriching the money centers in coastal cities. To be clear, the financial crisis underscored the need for new regulations. The purpose of Dodd-Frank was to end too big to fail, but it ended up creating too small to succeed. These new regulations entrench the dominance of the largest banks by rewarding economies of scale and necessitating effective lobbying operations here in Washington. What followed was a community bank bottleneck that left America's hometowns reeling. President Trump and this administration have seen what the heavy hand of government has done to community banks and the families you all serve, and he has set out to fix it. Why? Because we know that the Main Street revival starts with a community bank comeback. How will we position community banks to succeed? Let's start with the early wins. Just days after President Trump was sworn into office, the administration began rolling back the regulatory excesses of the Biden years. The regulators ended the politicized use of reputation risk and supervision. They proposed to rescind an embarrassing, complicated 60,000-word Community Reinvestment Act rule, and they retracted a merger policy statement that was both bad policy and bad law. The previous administration pushed for rules and guidance that micromanaged corporate governance, entangled the bank regulators in climate risk management, unduly restricted brokered deposits, precluded responsible bank innovation in crypto and other blockchain technologies, and imposed arbitrary restrictions on incentive compensation. These Biden-era proposals were bad for banks, bad for business, and bad for America, especially Main Street. So President Trump slashed all of them. To restore the strength of community banks, the new administration has replaced this draconian agenda with a new, more constructive agenda. The FDIC, for example, has recommitted to tailoring by proposing to raise and index asset thresholds. It has streamlined examination procedures and branch applications. It has started work to reestablish a supervisory appeals body. Not to be outdone, the OCC has implemented its own reforms. Controller Gould has been on the job for only 12 weeks, but he's already reduced assessments on small banks by 30%, reversed the plan to merge community bank supervision into large bank supervision, and replaced community banks' formulaic examination schedules with a more risk-based approach. Vice Chair Bowman, meanwhile, has long advocated for revisiting the community bank leverage ratio. I expect that effort will soon culminate in a proposed reduction in the community bank leverage ratio. The CFPB, for its part, has started to revamp the Section 1071 reporting requirements and reconsider the open banking rule. And it has withdrawn more than 60 interpretive rules and other guidance documents. Following the administration's example, Congress has also taken up the effort. It has nullified the CFPB's overdraft rule and prohibited the furnishing of mortgage-related trigger leads. The House Financial Service Committee has likewise advanced 24 important reforms to community bank regulation, while the Senate Banking Committee held a hearing and hopefully will soon mark up an expansion of FDIC insurance on non-interest-bearing transaction accounts. There is still much to look forward to on the regulatory front. This includes 2 new proposals that will reset the culture of supervision. 2 days ago, the FDIC and the OCC proposed a rule that would codify the recently adopted prohibition on using reputation risk as a basis for supervisory criticism. The FDIC and the OCC also proposed a rule that would define unsafe or unsound practice or condition. While simply defining a term might sound like a small thing, it marks a big step forward. Only in the world of unaccountable regulators could a key concept have gone unidentified for so long. The past failure to define this term led to supervisory criticisms focused on process or documentation related to governance, model management, and third-party risk management. In other words, topics that often had little or nothing to do with a bank's actual financial condition. This regulatory myopia was the driving force behind the spring of 2020-23 bank failures. Once finalized, a clear focus on material financial risk will put an end to this nonsense. I'm also optimistic about AML CFT reform. In my meetings with community bankers, they list CTR filings, structuring SARs, and process-focused examinations among their top concerns. Today, FinCEN released FAQs to address pain points on some of these issues, including triggers for restructuring SARs, continuing activity reviews, and the absence of any requirement to document a decision not to file a SAR. These are common sense, yet consequential reforms that will ease regulatory burdens without undermining law enforcement efforts. As part of our broader campaign to modernize illicit finance regulation, FinCEN and the bank regulators are hard at work on a new rule to define the requirements for an effective AML CFT program. My expectation is that a proposal will recenter supervision where it should be, on the effectiveness of a bank's AML CFT program. I likewise expect that proposal will position FinCEN as a gatekeeper for AML CFT enforcement. This will be a significant departure from the past with its zero-tolerance focus on process, documentation, and wide latitude for supervisory expectations and judgments that are not always consistent with the law or our national security priorities. A focus on higher value activities will also better serve our law enforcement and national security objectives. These are all important victories, to be sure, but much work remains to be done. Where do we go from here? Going forward, Treasury will continue to drive reforms to improve regulatory tailoring, refocus the culture of supervision, and modernize our illicit finance regulation. Specific priorities will include reforms to the rating system, new processes for monitoring examiners' compliance with supervisory policy, mechanism for independent appeals of supervisory criticisms, coordination to avoid duplicative examinations by different regulators, and review of the core platform providers, including contract terms that prevent community banks from innovating for the future. For community banks to go back on the offensive, we need to take a closer look at the dynamics that have undermined the community bank model and work to fix them. To that end, as I have said before, Treasury is focused on ensuring that modernization of our capital framework ends the capital arbitrage that drives bank lending to non-banks. This will likely entail reduced capital requirements for large banks on mortgage loans, investment-grade corporate loans, and some other important exposures. We must therefore ensure parity by giving smaller banks at least the option to benefit from these reduced requirements. Treasury has also supported congressional efforts to modernize the deposit insurance framework. I'm encouraged to see emerging bipartisan support for increasing FDIC insurance limits on non-interest-bearing transaction accounts. In addition to these efforts, Treasury has taken an informed and careful approach to Fannie Mae and Freddie Mac. Any actions on the GSEs must not increase borrowing costs and must preserve what works in the current system. That includes the prohibition on volume-based discounts for large lenders, as well as the cash window and other features that preserve equal secondary market access for small lenders. Now, allow me to close with a call for action. Before President Trump took office, community banks spent decades on the defense. But under President Trump's leadership, the game has changed. The playing field will be even more even. The ball is in your hands again. What happens next is up to you. So my advice, go on the offense, retake market share, chase after customers, champion technology, leverage the new regulatory landscape to your advantage, and expand your role in the American economy. The community bank comeback will help pave the way for America's golden age. Recognize the outsized role you play in this effort and embrace it. Because if you lead the way, Main Street will follow. Thank you.
I'd like to add my welcome to everyone. Thanks for being here. Thomas Laubach's research and his broader support of the FOMC helped us better understand monetary policy, and it is fitting that this work will continue today in his name. Thank you to the authors of the papers, to the discussants, and to our panel participants, and thank you also to Trevor and his team for organizing this conference. A whole lot of work went into bringing us together. As in our last review, the 2025 review consists of three key elements: this conference, Fed Listens events at the reserve banks around the country, and policymaker discussions and deliberations supported by staff analysis at a series of FOMC meetings. In the current review, we will reconsider aspects of our strategic framework in light of the experience of the last 5 years. We will also consider possible enhancements to the committee's policy communication tools regarding forecasts, uncertainty, and risks. In 2012, the FOMC first codified our monetary policy framework in a document entitled the Statement on Longer-Run Goals and Monetary Policy Strategy, which we refer to as the Consensus Statement. The language in the opening paragraph, which has never changed, articulates our commitment to fulfilling our congressional mandate and to explaining clearly what we're doing and why. That clarity reduces uncertainty, improves the effectiveness of our policy, and enhances transparency and accountability. As chair, Ben Bernanke led the committee through the creation of that initial consensus statement, adopting a 2% inflation target and outlining our approach to achieving our congressionally assigned dual mandate. The framework laid out in that document broadly aligned with best practices for a flexible inflation targeting central bank. The structure of the economy evolves over time, and monetary policymakers' strategies, tools, and communications need to evolve with it. The challenges presented by the Great Depression differ from those of the Great Inflation and the Great Moderation, which in turn differ from the ones we face today. A framework should be robust to a broad range of conditions, but also needs to be updated periodically as the economy and our understanding of it evolve. From 2012 to 2018, the FOMC voted at each January meeting to reaffirm the consensus statement, in most years without substantive changes. In 2019, we changed that practice, conducting our first ever public review, and said that we would repeat such reviews at roughly a 5-year interval. There's nothing magic about a 5-year pace. We believe that frequency is appropriate to reassess structural features of the economy and to engage with the public, practitioners, and academics on the performance of our framework. Several of our global peers have adopted similar approaches to their framework reviews. At the time of the last review, we had been living for about a decade in a new normal characterized by proximity to the effective lower bound, with low interest rates, low growth, low inflation, and a very flat Phillips curve. If I could capture that era with one statistic, it would be that the policy rate had been stuck at the lower bound for 7 long years following the onset of the global financial crisis in late 2008. After liftoff in December 2015, we were able to raise the policy rate only very gradually over a period of 3 years to a peak of just 2.4%. 7 months later, we began reducing it, leaving the rate at 1.6% in late 2019, where it would be when the pandemic arrived a few months later. Policy rates in other major advanced economies were even lower, in many cases below zero, and in all such economies, inflation regularly ran below its target. The sense at that time was that when the economy next experienced even a mild downturn, we would be right back at the lower bound, probably for another extended period. The post-financial crisis decade had demonstrated the pain that that could bring. Inflation would likely decline in a weak economy, raising real interest rates as nominal rates are pinned at zero. Higher real rates would further weigh on job growth and reinforce downward pressure on inflation and inflation expectations. Reflecting these concerns, we adopted a policy to make up for persistent shortfalls from the inflation target, an approach that was common in the extensive literature on the risks associated with the lower bound. Given the downside risks to employment and inflation from proximity to the lower bound, and the need to anchor longer-term inflation expectations at 2%, we said that following periods in which inflation has been running persistently below 2%, we would likely aim to achieve inflation moderately above 2% for some time. We also concluded that policy decisions would be informed by assessments of shortfalls rather than deviations from maximum employment. The change to shortfalls was not a commitment to permanently forswear preemption or to ignore labor market tightness. Rather, it signaled that apparent labor market tightness would not, in isolation, be enough to trigger a policy response, unless the committee believed that, if left unchecked, it would lead to unwelcome inflationary pressure. This change reflected our experience with long expansions that featured historically low unemployment amid low and stable inflation, suggesting that a policy approach that carefully probed for the maximum level of employment could bring about the benefits of a strong labor market without risking price stability. In the years just prior to the pandemic, for example, unemployment was at multi-decade lows while inflation ran below 2%. By December 2019, estimates of the longer-run unemployment rate had fallen sharply. The use of shortfalls acknowledged that a combination of low inflation and low unemployment does not necessarily pose an adverse trade-off for monetary policy. The economic conditions that brought us close to the lower bound and drove the changes in our consensus statement were thought to be rooted in slow-moving global factors that were likely to persist for an extended period, at least until our next 5-year review. And that might well have been the case had the pandemic not intervened. The idea of an intentional moderate overshoot proved irrelevant to our policy discussions and has remained so through today. There was nothing intentional or moderate about the global inflation that arrived a few months after we announced our changes to the consensus statement, and I acknowledged as much publicly in December 2021. We fell back on the rest of the framework, which called for traditional inflation targeting. Through the end of 2021, FOMC participants continued to forecast that inflation was likely to subside fairly quickly in 2022, with only a moderate increase in our policy rate. That projection was consistent with other central banks with different frameworks and the vast majority of forecasters. When the evidence showed otherwise, we hiked 525 basis points over a period of 16 months. The most recent data suggests that 12-month PCE inflation was 2.2% in April, far below its 7.2% peak in 2022. And in a welcome and historically unusual result, as this room knows, this disinflation has come without the sharp increase in unemployment that has often accompanied a campaign of rate hikes to reduce inflation. The economic environment has changed significantly since 2020, and our review will reflect our assessment of those changes. Longer-term interest rates are a good deal higher now, driven largely by real rates, given the stability of longer-term inflation expectations. Many estimates of the longer-run level of the policy rate have risen, including those in the Summary of Economic Projections. Higher real rates may also reflect the possibility it's only prudent that the framework continue to address that risk. While the framework must evolve, some elements of it are timeless. Policymakers emerged from the Great Inflation with a clear understanding that it was essential to anchor inflation expectations at an appropriately low level. During the Great Moderation, well-anchored inflation expectations allowed us to provide policy support to employment without risking destabilizing inflation. Since the Great Inflation, the U.S. economy has had 3 of its 4 longest expansions on record. Anchored expectations played a key role in facilitating these expansions. More recently, without that anchor, it would not have been possible to achieve a roughly 5 percentage point disinflation without a spike in unemployment. Keeping longer-run inflation expectations anchored was a driving force behind establishing the 2% target in the 2012 framework. Maintaining that anchor was a major consideration behind the changes in 2020. Anchored expectations are critical to everything we do, and we remain fully committed to the 2% target today. In the current review, the committee is engaged in discussions about what we have learned from the experience of the past 5 years. We plan to complete consideration of specific changes to the consensus statement in coming months. We're paying particular attention to the 2020 changes as we consider discrete but important updates reflecting what we have learned about the economy and the way those changes were interpreted by the public. In our discussions so far, participants have indicated that they thought it would be appropriate to reconsider the language around shortfalls. And at our meeting last week, we had a similar take on average inflation targeting. We will ensure that our new consensus statement is robust to a wide range of economic environments and developments. In addition to revising the consensus statement, we will also consider potential enhancements to our formal policy communications, particularly regarding the role of forecasts and uncertainty. As we have been reviewing assessments of the 2020 framework and of policy decisions in recent years, a common observation is the need for clear communications as complex events unfold. While academics and market participants generally have viewed the FOMC communications as effective, there is always room for improvement. Indeed, clear communication is an issue even in relatively placid times. A critical question is how to foster a broader understanding of the uncertainty that the economy generally faces. In periods with larger, more frequent, or more disparate shocks, effective communication requires that we convey the uncertainty that surrounds our understanding of the economy and the outlook. We will examine ways to improve along that dimension as we move forward. So let me end by saying thank you again for being here. We've been looking forward to this. All of us have been looking forward to being with you today and having these conversations that will occur over the next 2 days. These discussions will help broaden and deepen our thinking about these issues, and they're critical to the success of these reviews. Thank you very much.
Back, everyone, to the last session of the day, which is going to focus on the tools that the committee has available to implement its policy framework. My name is Annette Wissing-Jorgensen. I'm a senior advisor in the Monetary Affairs Division here at the board. Along with Trevor Reeve and David Lopez-Salido, I've been in charge of picking the speakers and the discussions, so let me know if there were any that you particularly enjoyed. We have a star-studded lineup for today's panel. Our paper presenter will be Silvana Tenvero, who's an economics professor at the London School of Economics. Silvana has served as external member of the MPC at the Bank of England from 2017 to 2023, and is a renowned expert on both monetary policy as well as international trade. Her list of academic honors is too long to cover within the allocated time, but we look forward to the paper. Our discussion will be Sam Hansen. Sam is a finance professor at Harvard Business School. He's an expert in macrofinance and has worked on many topics at the intersection of monetary policy, macro and finance. In addition to being a finance professor at HBS, he's worked for an, should I say, esoteric list of institutions, including the Lehman Brothers, the New York Fed, and the U.S. Treasury, where he served as a special assistant and liaison to the White House National Economic Council. With that, let me turn it to Savannah.
Thank you very much, Annette. So thank you very much for having me in this conference named after Thomas Lovac. Thomas was a phenomenal economist and a role model for many of us who started our careers as economists at the Federal Reserve System. So I will talk about unconventional policy tools at the Fed. That was my homework. Lessons from theory and practice. And this is based on joint work with Mo Watsi, who's here from Oxford University. Let me start with a very brief motivation. Unconventional policy tools have played a central role since the global financial crisis, and they were extensively used during the COVID pandemic. As part of the Fed's policy strategy review, it's important to evaluate their design, transmission, and effectiveness. So we focus in our paper on the two most important unconventional monetary policy tools used by the Fed, forward guidance and large-scale asset purchases. In my presentation today, I will first briefly discuss the theory and evidence behind these tools. There's a more thorough discussion in the paper for those interested. Next, I will zoom in on the 2020-2024 experience, drawing some takeaways and reflections from the actions taken by the Fed during this period. And finally, I will highlight what we think are the main lessons and some of the open questions that require more research. Just to be clear from the outset, our focus is not on the appropriateness of the monetary policy stance taken by the Fed during this period. That's part of a separate discussion. Our focus is on the tools themselves. Are they effective? Should they be kept in the toolbox? How can we improve their design? So starting with forward guidance, understood as central bank communication regarding the future path of policy or the economy. It was not new or unconventional. The Fed had started using some form of forward guidance back in 1999, although its use intensified after the global financial crisis. The literature has distinguished between two conceptual forms, Delphic and Odyssean. Delphic guidance entails a forecast of the likely future path of policy without any commitment. And this consists mostly of communications of the Fed's reaction function. By nature, this Delphic guidance is state contingent and time consistent. The second form is Odyssean, which consists of stronger guidance with at least partial commitment to a policy path. And that commitment is often, it goes beyond the boundaries of the mandate. Now, what we define as Delphic or Odyssean depends on the framework's mandate. So, for example, with the Fed's flexible average inflation targeting framework, guidance to achieve an overshoot in inflation in the future to make up for past shortfalls would be considered Delphic. The make-up strategy is embedded in the framework. In contrast, before the pre-2020 framework, any guidance regarding a future overshoot in inflation would be thought of as Odyssean, entailing a commitment that goes beyond the mandate. Now, unlike the policy rate, which is a simple scalar, forward guidance is a multidimensional tool and can take many specific forms, from open-ended and involving perhaps conveying little information, but entailing high flexibility for the policymaker, to the other extreme of calendar-based guidance, which offers greater certainty about the policy path, but limits the flexibility of the policymaker. And everything in between, including state contingent guidance or guidance that embeds some knockout clause in it. Now, over the years, the Fed has used different forms of guidance, and in the paper we discuss those different examples, along with the pros and cons of the various forms. Now, theory tells us that both forms of forward guidance, Odyssean and Delphic, reduce uncertainty, lowering the risk premium and the term premium. And additionally, with stronger commitments, forward guidance can also lead to lower expectations of the policy rate in the medium and longer term. Even without those commitments, some form of Delphic guidance can also lower interest rate expectations if, for example, the market pricing is sufficiently misaligned with the Fed's reaction function. By lowering rates, forward guidance should lead to higher expectations of inflation and growth, and hence increase spending by households and firms. That's the theory. And the evidence suggests that forward guidance indeed reduced interest rate uncertainty and had significant effects on yields, equities, and broader asset prices. And while it's reassuring that this first stage of the transmission mechanism has worked, direct evidence on the macroeconomic impact on output or inflation is less conclusive, and the effects of forward guidance tend to be imprecisely estimated. There is a very nice paper by Thomas Lovac, recently updated by his co-authors, making precisely this point. And there's other work. Swanson has a paper making the point that forward guidance has been important in pushing up output, but there's some disagreement in the empirical literature. Let me now turn to asset purchases, and sometimes I will use QE for short. We examine large-scale asset purchases financed by central bank reserves. These purchases are asset swaps. They change the asset composition of the buyer and seller's balance sheet. And as such, they're not direct transfers of wealth. And this is in contrast with some popular mischaracterizations of QE as helicopter drop or bank bailouts and so on. Again, unlike the policy rate, asset purchases are multidimensional tools, and they can have very different asset structures, purpose, and design. In terms of assets, the Fed has purchased mostly US Treasuries and mortgage-backed securities, and during the COVID pandemic, it also bought corporate bonds. And within those bonds, there are differences in maturity and risk. In terms of purpose, the purchases can be done for monetary policy purposes to stimulate the economy, or for financial stability purposes, providing liquidity in times of market stress. And in terms of design, they can consist of fixed quantity announcement versus open-ended flows. They can be specified in terms of prices or quantities, and so on. Now, the three main transmission channels identified by the theory are portfolio rebalancing, signaling, and liquidity. These channels can affect treasury yields, exchange rates, bank funding costs, and wider asset prices. And through that, they can lower borrowing costs and also push up collateral or increase, produce wealth effects that eventually lead to more spending and income. And finally, the last step is pushing up on inflation and activity. So in our paper, we describe these transmission channels at length, along with the theory and evidence behind them. Broadly speaking, there is evidence in favor of all three channels, and there's also new evidence for what we can call the backstop channel, the idea that the announcement of asset purchases by the Fed can act as a put, reassuring markets that the Fed will act again in times of market disruption. They may also work through a bank lending channel, which was important in Europe, but less so in the US. One point to observe is that often these channels are studied separately, and there's no unified framework to decompose their different contributions or make them add up to an overall impact. And I will discuss this point again at the end. Turning to the macroeconomic effects of asset purchases, the evidence indicates that large-scale asset purchases were effective as aggregate demand tools, pushing up on activity and inflation. And again, here there's a very nice contribution by Thomas, finding significant effects on activity and prices. One observation, though, made by Fabo and co-authors is that there is wide dispersion in macro estimates across times, across countries, and across different methods. And this variation can be explained by differences in identification strategies, modeling assumptions, and transmission channels emphasized. And to appreciate or to illustrate this dispersion, this, I think, is a very instructive graph taken from Gulati and Smith's meta-analysis. The graph summarizes the range of estimated effects from asset purchases mapped into 10-year yield space. So taken at face value, it says that the cumulative impact of asset purchases on 10-year yields is somewhere between 1.25 and 4 percentage points. And this is a very big range, of course. But notwithstanding the range, I think the evidence is firm in the fact that these asset purchases had an impact on activity and prices. And based on that evidence, our recommendation is to keep these large-scale asset purchases in the monetary policy toolkit. They might be needed in case the economy hits the ELB again, the effective lower bound, or if there is market disruption, which would require to intervene with the financial stability goal. In the case of forward guidance, we think Delphic guidance should be standard practice in central banks' communication, and Odyssean should be left for very extreme circumstances. Of course, how effective these tools are depends on how they're calibrated and deployed. And in the rest of my presentation, I will focus on this point and see what we can learn from the recent experience for future use of these monetary policy tools. So let me turn to that post-2020 experience. So regarding forward guidance, during this period, the Fed used at least 4 different types of guidance. First, the dot plots, which was a continuation of a practice started back in 2012. Second, and to a large extent underpinning those dot plots, the Fed had guidance on interest rates, and third and related, guidance on the asset purchases. Finally, there was also guidance on the sequencing of an eventual liftoff or tightening of monetary policy. Let me go through this, through the interest rate guidance and asset purchase guidance first. The rate guidance introduced in September 2020 and maintained until November 2021 indicated the intention of the FOMC to keep the target range of the federal funds at 0 to 0.25% until the labor market conditions had reached levels consistent with the committee's assessment of maximum employment, and inflation had risen to 2%, and it was on track to moderately exceed 2% for some time. The asset purchase guidance introduced in September 2020 and maintained until June 2021 was to continue to increase holdings of Treasury securities by at least $80 billion per month and of mortgage-backed securities by at least $40 billion per month until substantial further progress had been made towards the committee's maximum employment and price stability goals. So it's clear that the guidance for rate liftoff was much more demanding, or the conditionality was more demanding than for stopping asset purchases. It required 3 conditions: maximum employment, realized inflation at 2%, and expectations that inflation would overshoot moderately the 2% target for some time. For asset purchases, it simply required evidence of progress towards maximum employment and price stability. And finally, the ancillary guidance on sequencing of tightening introduced a timing component in the form of two conditions. First, the interest rate liftoff would start after the asset purchase program was concluded. And second, the FOMC intended to provide ample warning or lead time before starting the tapering of asset purchases. So we can see here that the rate and asset purchase guidance were state contingent, but the sequencing guidance had a more rigid component linked to time. So potentially there could have been tension between the sequencing guidance and the rate guidance if, for example, the three conditions for rate liftoff were reached right after the conditions for asset tapering. This would have forced the Fed to give up on the ample warning or to delay liftoff. So that was forward guidance. Turning to large-scale asset purchases, the decisions can be split into two phases, given the motivation. The first phase was about smooth market functioning, and the second added monetary policy stimulus to the motivation. Specifically, in March and April 2020, the FOMC announced asset purchases aimed at supporting smooth market functioning, including on the 15th of March, purchases of at least $500 billion on treasuries and $200 billion on mortgage-backed securities. On the 23rd of March, the program was expanded to unlimited purchases of treasuries and mortgage-backed securities. And plus, for the first time, the Fed started buying investment-grade corporate bonds. On the 9th of April, the corporate bond program was expanded to include also some high-yield debt as well. So going to the second phase, in September 2020, the Fed expanded the justification for purchases of US treasuries and mortgage-backed securities to include not only a market functioning goal, but also fostering accommodative financial conditions. So there were, from September onwards, two goals behind the asset purchases. And in December 2020, the committee added the forward guidance I discussed before, which focused on the monetary policy goals of price stability and maximum employment. So what are our main reflections from this experience? So when it comes to forward guidance, it's clear that there is a trade-off between commitment to a policy course of action aimed at achieving high initial effectiveness versus having the flexibility to come out of the policy path or the QE program. And our reading is that the Fed's choices were tilted towards that commitment and having high effectiveness, putting perhaps less weight on the flexibility to exit. In particular, if we look at the forward guidance criterion for rate liftoff, they set a very high bar to increase interest rates. And one could argue that they were insufficiently robust to unexpected shocks that could create a trade-off between the objectives of maximum employment and price stability. This is why we hindsight, and I should emphasize the word hindsight, we think stress testing forward guidance under different scenarios could be highly beneficial and become routine practice in central banks. I will come back to this later. And just to illustrate what the point I'm making, we can compare the conditions embedded in the 2020 guidance with those in the 2012 guidance. And for this, I'm using this graph that I reproduced from English and SAC. The horizontal axis here shows inflation, and the vertical axis shows unemployment. The shaded area in each plot indicates the no liftoff zone. That is, the policy rate is expected to remain without change in the shaded area. So on the left-hand side, we can see the representation of the 2012 guidance. It contemplated the possibility of a trade-off between inflation at target and maximum employment. Rates would be increased, the liftoff area here in white, if either unemployment fell below 6.5% or projections of inflation 1 to 2 years ahead increase above 2.5%. So the wording here was structured to achieve a balanced trade-off between inflation and employment. And the conditioning was based on projections of inflation rather than actual outcomes. On the right-hand side, we can see the 2020 guidance. The conditions for liftoff, the white area, required both inflation above target and unemployment below the natural rate. So the wording did not contemplate the possibility of a trade-off between these objectives. The second point I'd like to stress here is that the ancillary guidance on sequencing could have clashed with the main guidance on rates and purchases. As I said before, if the time between the fulfillment of the conditions for QE purchases and the conditions for rate liftoff was too short, then giving ample warning for tapering would have delayed liftoff. The third point I want to make here is that the guidance was outcome-based, conditioning on actual realizations of inflation rather than projections. And in general, this outcome-based guidance limits the ability to act preemptively in response to a changing outlook or even changing risks. And finally, the last observation here is that the escape clause, there was escape clause there, but it was not sufficiently integrated in the main guidance, and it was seen as a separate and boilerplate statement. Now, let me turn to asset purchases. Here I'll make two observations. First, purchases were successful at restoring market functioning, and there's a very nice paper by Annette showing this. And the various rounds provided impactful monetary policy stimulus, and this is what the evidence I summarized or mentioned before was telling us. The second point is that there was unclear differentiation or insufficient differentiation between the goals behind the purchases, whether it was done for monetary policy stimulus or for liquidity provision in a disrupted market. And related, although the share of long-dated treasuries purchased did increase after September 2020, the structure of the purchase between treasuries and mortgage-backed securities didn't change after that. We think a clearer separation in design and message could enhance the effectiveness and increase the agility of policymakers to change course if needed. So what are the lessons we draw? Again, I think the evidence indicates that these unconventional tools have been effective as aggregate demand tools. They move yields and asset prices, and they can effectively provide monetary policy stimulus. And in light of that, we take it as a given that both tools should be part of the toolkit. There's no reason to lose an instrument. With that as a premise, the overall lesson we draw is that when designing and deploying these unconventional policies, it's important to consider the balance between policy effectiveness at the time of deployment and the flexibility needed to respond to future shocks. And we think that stress testing policies before deployment using scenario analysis should be very helpful in the design and implementation of both forward guidance and asset purchases. And this projection into different scenarios should make policies more robust to changing outlooks or changing risks. And in this way, the policymaker will have more information to decide when and how to use these policies. Let me now move to more specific lessons for each of the tools. So this stress testing, we think, is important for both. When it comes to forward guidance to this, I would add a couple of points. So first, lesson stress testing. Second, state contingent guidance provides a better balance between flexibility and effectiveness. And policymakers should pay attention to the conditionality and perhaps be willing to give up some effectiveness initially to gain flexibility for later. The third point is that the contingent nature of the policy must be very clear with perhaps a simple integrated escape clause that is part of the main statement. Fourth, forward guidance should avoid being too outcome-based and have, and given the lags in the transmission of monetary policy, guidance should try to be allow for more preemptive adjustments in the monetary policy stance. And finally, it should be clear that guidance could be revised in extraordinary circumstances. We think all these principles should be there at the deployment stage. And of course, all these considerations must be weighed against the need for the language to be accessible and clear. Turning to asset purchases, the specific lessons, so again, starting lesson 1 would be to stress test the purchase, considering different scenarios. Lesson 2 is to have a clear distinction between the goals. By not differentiating them, the unwind of purchases made for liquidity purposes becomes too tied to monetary policy and perhaps sending the wrong signal. With differentiation, tapering, ending, or unwinding liquidity purchases would be interpreted as a positive signal about market conditions rather than linked to monetary policy, and this will allow for less policy inertia. If purchases are kept as a single integrated tool, we think the structure of the purchase program should align with those evolving goals, and perhaps we didn't see this as clearly in this episode. Finally, while sequencing liftoff after ending asset purchases might be desirable for many reasons, we think it shouldn't be a hard constraint, and the Fed should be willing to ignore it if needed. So let me turn to the 3 open questions, or rather the pending agenda for researchers. I'd like to emphasize 3 areas. The first one is that the range of estimated impacts of forward guidance and asset purchases remains wide, and perhaps too wide for comfort. We're not in a position to answer some very critical questions, like how much have asset purchases lowered the curve, and how much past purchases are still currently lowering it. How persistent are these estimated effects? In finance, we tend to interpret the impact of these announcements on asset prices as permanent, and this makes sense if we think about markets as efficient. But the Fed is intervening here when markets are not operating efficiently, so this standard market efficiency assumption cannot be taken for granted. So having a more precise answer, for example, today would allow us to answer a very pressing question: what's the impact of quantitative tightening on the yield curve today? How much of the recent increase in yields is due to QT? And so on. The second point is that while there are many great empirical and theoretical studies of the different forward guidance or asset purchase interventions, we don't have a sound, unified framework to assess macroeconomic benefits and cost. And there is a nice paper by Davernaz and co-authors going in this direction. We need more of this. Having an integrated framework is helpful for accountability and transparency, and it will allow policymakers to more clearly answer in Congress or to the public questions such as why were the actions taken, were they worth it, and so on. And this is important because often the discussion outside of central banks tends to be narrowly focused on the fiscal costs of asset purchases, and more specifically on the central bank's balance sheet losses, missing the broader macroeconomic benefits. So having the framework will be informative and clarify the rationale behind these policies. And here I also like to stress that when asset purchases are done for monetary policy purposes and the economy is at the effective lower bound, it's very natural to have losses in the balance sheet. That's a sign that the policy was successful and able to get the economy out of the effective lower bound. And so this should not be read as failure, but as success. When the operation is done for financial policy, financial stability purposes, maybe there is more scope for gains, but in general, this should loom very small compared to the broader macroeconomic benefits of these programs. Finally, I think other tools should not be ruled out, and Ken is here about negative rates. The evidence from European countries and the ECB suggests that negative rates can provide monetary policy stimulus in recessions, opening additional monetary policy space, and this is particularly helpful when long yields, for example, are already very low, and doing more asset purchases doesn't provide further stimulus. So to conclude, our recommendations are first, keep the instruments in the toolkit. They are effective aggregate demand instruments at the effective lower bound. And away from the lower bound, they might be helpful to provide financial stability, definitely for asset purchases, and above the lower bound as well, Delphi guidance should be helpful in communicating the Fed's reaction function. Second, at the design and implementation stage, stress testing the instruments to have a policy that is more robust should be beneficial and will allow the policymaker to balance the different trade-offs. Third, clarify objectives, which is important and might give the Fed more flexibility to exit some of the purchases done for financial stability purposes. Fourth, encourage more research. We need further work on narrowing these estimates of the unconventional policies' effects on inflation and activity, and have more work on creating this integrated framework to assess benefits and costs. And finally, remain open to other tools, including negative rates that could provide this extra space if we were to reach or hit the lower bound again. And I hope these reflections are seen in the spirit of helping to strengthen the toolkit for the challenges ahead. Thank you.
Thank you very much.
All right. Thank you very much for having me to discuss this paper. Just to kind of get started, obviously we think that much of monetary policy's impact on household consumption and investment, and hence the broader economy, arises from its impact on broader financial conditions. In particular, kind of the most important, our baseline set of financial conditions are just the level of long-term interest rates. I'm a finance professor, so I obviously think of those as reflecting the expected path of short-term interest rates, and then plus a term premium. And this term premium essentially reflects forces that shift the supply and demand for long-term bonds relative to short-term bonds. You can think of this as sort of including the return compensation that investors require for bearing the interest rate risk of holding long-term bonds. All right, so conventional policy is obviously we're moving around the current short-term policy rate. What are the unconventional policy tools that the Fed has? The first one is obviously forward guidance. We're communicating about the future path of short-term policy, hoping that is influencing expectations of future short-term interest rates, and perhaps by reducing uncertainty, term premium as well. Second, large-scale asset purchases. We're buying assets using interest-bearing reserves. The hope here is we're influencing this term premium or other risk premium, but it might also end up influencing expectations of future short rates. And here the goal is to provide stimulus to the economy by easing financial conditions. And then finally, the kind of other unconventional monetary policy tool would be sort of liquidity facilities. So these would be making short-term collateralized loans, but not kind of traditional discount window lending. And oftentimes, facilities like this are essentially designed using Bagehot's dictum, where we're trying to lend freely against good collateral at a penalty rate. And oftentimes here, the goal is essentially to support orderly functioning of key markets. All right, so I'm going to make 3 points essentially, just underscoring and building on what Silvana said. So the first is about forward guidance. Here, essentially, I would basically kind of echo and completely agree that we can probably do a better job of striking an optimal balance between commitment and flexibility, and that in some sense we may kind of have opted for a bit too much commitment. So as Silvana said, the very sensible way to think about this, to determine kind of the optimal balance, we want to stress test potential formulations of forward guidance in the face of large shocks, particularly supply shocks, that could create trade-offs between the goals of price stability and full employment. All right, so to echo kind of 3 concrete suggestions from Silvana's paper, the first is what, just a simple way to say it is or as opposed to and. So this is something that Bill English and Brian Sack emphasized in a recent paper. This is there's quite a significant difference between the 2012 styled forward guidance, which said we'll lift off from the effective lower bound if either the unemployment rate is below some target level or if inflation starts to rise above a target, and 2020 style forward guidance, which said we'll only lift off if both of those occur. Okay? And so this, 2020 guidance kind of lacked this clear escape clause that could be quite important if there was an unexpected supply shock. Second, seems quite useful to condition forward guidance on near-term forecasts as opposed to realized data. So, this couching guidance in terms of near-term expectations is going to be a much more robust solution in a world where we think that there are lags between policy implementation and its full impact on the economy, and second, where there also may be external shocks that hit the economy that take some amount of time to fully impact the economy and show up in the hard data. Third, this suggestion of essentially trying to de-link guidance on the short-term policy rate from guidance on large-scale asset purchases. In the last 2 cycles, the Fed has essentially kind of signaled a reluctance to lift off from the effective lower bound until purchases have been completely tapered, so they've stopped buying assets on net. And also, at the same time, a desire to gradually taper asset purchases in order to avoid market disruptions. So the combination of these means that if we have an open-ended large-scale asset purchase program that has a high monthly purchase volume, that essentially becomes a commitment to keep short rates low for the length of time over which in order for you to slowly taper. Not clear, not 100% clear to me why these two need to be linked, why rates can't lift off until purchases cease. Also not completely clear why purchases need to taper so gradually. As I'll kind of talk about in a moment, one of the key channels that we think of quantitative easing operating through is essentially a stock-like effect. It's the amount of duration that we're moving from the market. That's really the kind of reason it's not clear why we need to taper the flow so gradually. In some, obviously we want to learn from past market events, but maybe some worry that the kind of very strong preference for tapering so gradually may reflect some amount of overlearning from the 2013 taper tantrum. A way of saying this is that we may be somewhat stuck in what my good friends Jeremy Stein and Adi Sundaram would call a gradualism trap. So this would be a situation where the central bank has a bit of private information, say about its reaction function. The central bank doesn't like bond market volatility, and as a result, it tries to gradually adjust its policies in response to its private information. Of course, the market understands that the central bank has gradualist tendencies, and as a result, even if the central bank is making small policy changes, the market is significantly revising its forecasts. So gradualism essentially does not end up reducing volatility, and the central bank would just be better off if it abandoned gradualism. What are some potential solutions? The first is essentially just clearly communicate to markets that we might need to quickly taper purchases in response to major surprises and shocks. The second would be to kind of promote a policy culture that is just slightly less concerned with high-frequency market reactions to announcements as opposed to kind of long-run impact. All right. So second thing I want to talk about is large-scale asset purchases. Obviously the Fed has primarily purchased long-term treasuries and mortgage-backed securities since 2008. Typically, the goal has been to stimulate the economy by easing financial conditions. We're trying to reduce long-term borrowing rates, essentially by reducing risk premium, particularly the term premium component of long-term yields. But as Silvana mentioned, some purchases have also been motivated by a desire to support orderly functioning of the Treasury market. By orderly functioning here, I essentially mean liquidity in the Treasury market, different Treasury securities that are similar, trading at similar prices. Obviously, during the COVID-19 period, the Fed began QE4. Essentially, it was an open-ended program. Eventually purchased over $3 trillion of U.S. Treasuries and $1.3 trillion of MBS. Started out based on this, rationale of supporting smooth market functioning during March of 2020, when the Fed was buying Treasuries at a very, very rapid clip. But then in September of 2020, changed into one of trying to provide more accommodative conditions to financial markets, kind of the traditional rationale for large-scale asset purchases. All right, so what I want to talk about is sort of what do we know and what do we not know about large-scale asset purchases. Silvana's paper, I think, did a great job of laying out what we do know, but probably more importantly, she summarized really well what we don't know about large-scale asset purchases. And this is kind of the metaphor that I often use when teaching students about monetary transmission. I think of kind of monetary transmission as being like a doctor who's treating a patient that has an illness, but the illness is continuously evolving in real time. Even if we could figure out precisely how different types of treatments work, how different tools are transmitted into the economy, the sickness would morph in unexpected ways. So, the nature of monetary transmission is ever evolving. That's really fun as a researcher, but is much more difficult when you're a policymaker. That we need to ultimately approach unconventional policy with the same humility as conventional policy. All right, so what do we know? The first thing I think we know is that large-scale asset purchases do in fact reduce long-term yields. We know that they seem to work through several different financial market channels. So first, there's evidence for the portfolio balance channel. This is where the Federal Reserve is essentially buying up assets, trying to remove interest rate risk for the market, and kind of the sufficient statistics here should be the dollar amount of interest rate risk that is being removed from the market. There's also this backstop channel, which is essentially kind of a state contingent version of the portfolio channel, and the signaling channel, where the Fed's asset purchases convey information about the future policy rate. We know that the impact of large-scale asset purchases have varied over time. Particularly, the impact has been greatest, obviously, during periods of market volatility, when we would think that investor risk aversion is high. This is consistent with the logic of the portfolio balance channel. That said, we don't know the exact mix of these financial market channels, and we also do not know whether this mix varies over time. In a sense, we also don't know whether the ultimate transmission of large-scale asset purchases to the real economy depends on this mix of financial channels. So an example would be, we think that lower mortgage rates stimulate mortgage refinancing, home sales, home building. The question is, does it matter the mix of channels via which we lower mortgage rates? My prior, based on the household finance literature and maybe what Yuri was telling us about the people in the Michigan survey, is that the mix probably shouldn't matter. Households only care about the level of mortgage rates, not why rates have come down. If you told someone in the Michigan survey that it was because of term premium, and that, as a result, the path of mortgage rates essentially should be something like a sufficient statistic for the total amount of accommodation delivered. We know, in the short run, large-scale asset purchases definitely impact asset prices in the targeted asset class. We can see these short-run announcement effects. They're easy to measure, and they're meaningful. A thing that we don't know or know much less is how the effects spill over from targeted asset classes to other asset classes. So a classic question would be, to purchases of long-term treasuries, does that end up impacting risk premium in the stock market? Okay? We definitely see short-run announcement effects in the stock market, but it's hard to know whether that reflects changes in the fundamentals of the economy because large-scale asset purchases are stimulating the economy, or because it's reflecting changing financial conditions because LSAPs are moving risk premia. A useful prior here from theory, but is again something we don't know, if we think that large-scale asset purchases are working through a portfolio balance channel, they should really only impact risk premia to the extent that markets are somewhat segmented. The equity market is somewhat segmented from the bond market. What that means is that the marginal investor in, say, the bond market is a specialized bond investor who's bearing a lot of interest rate risk. They're bearing less interest rate risk following a large-scale asset purchase program, so that depresses the term premia. But that segmentation that the effects rely on is inherently going to limit the potential for spillovers from targeted asset classes to untargeted asset classes. Another important thing that I think we know less about is how persistent the effects of large-scale asset purchases are on asset prices. Essentially, we have only run this policy experiment a handful of times. We know that the short-run effects are there, but it's just hard to precisely estimate the long-run effects due to the inherent volatility of financial markets. Again, a prior from theory. Oftentimes we think that while asset classes, say the stock market and the bond market, might be segmented in the short run, they'll be less segmented in the long run because investors will gradually substitute between different markets. Essentially, things are always more elastic in the long run than they are in the short run. What that would mean is in the targeted asset class, say in treasuries, we'd expect the long-term effects on term premia to be less than the short-term effects. But we'd expect the spillover to non-targeted asset classes, say equities, to exceed the short-term effects. Final thing that we know less about is how this ultimately impacts consumption and investment. What we'd like to obviously measure is the kind of full transmission chain, large-scale purchases, ease financial conditions, that shows up in financing quantities, which has real effects. Obviously, to the extent that asset purchases have transient effects on long-term rates and financial conditions, they're going to have far less of a stimulative effect. My sense is, given the uncertainty we have about the persistence of their effects on financial conditions, navigating solely essentially by adding up past announcement effects might be unwise. And instead, essentially a better way to monitor this in real time is to seek evidence or look for evidence that asset purchases are leading to an easing of conditions that we actually see showing up in financing quantities. We want to see mortgage refinancing, home sales going up, the volume of corporate capital raising. And in fact, there has been evidence from different episodes that in fact we do see this transmission to financing quantities. But my sense is we kind of haven't focused enough on the second arrow, the transmission from financial conditions into financing quantities. Okay. Final point is this distinction between what's the rationale for large-scale asset purchases. Is it about improving financial conditions or supporting market function? In 2020, the Fed had two very distinct goals for large-scale asset purchases. The first was sort of the standard goal, reduce the level of long-term yields to ease financial conditions. I would call this sort of an absolute value goal. The goal is to reduce the absolute level of all long-term yields or to prevent kind of an incipient and unwanted spike in yields. This necessarily involves the Fed bearing more interest rate risk so that investors can bear less risk. When do we deploy this? Presumably it makes most sense when the policy rate is at the effective lower bound. If not, we just provide accommodation by reducing the funds rate at the lower bound, trade off the benefits of further accommodation from asset purchases against the associated fiscal risk. The second goal is to promote orderly functioning in bond markets. Is it easy and cheap to sell treasuries? Here you can think of this as sort of having a relative value motivation. We're trying to promote orderly trading by reducing yield differences between essentially very similar instruments, say treasuries and swaps or on-the-run treasuries versus off-the-run treasuries. typically we think of this market dysfunction as arising due to a tightening of the balance sheet or risk constraints of broker-dealers. And as I'll try to emphasize, addressing market functioning doesn't, and if it truly is market functioning, probably should not require the Fed to bear more interest rate risk. When to deploy? Presumably, we always want a well-functioning Treasury market. So if the cost of alleviating it is tiny, we should arguably deploy it whenever there's significant dysfunction in the Treasury market. Just to kind of draw an analogy, you can think of this as being there's two very different reasons why a central bank might intervene in currency markets. The first is it actually wants to do a foreign exchange intervention, the absolute value goal of actually changing the valuation of its currency, say to impact trade balances. This is where the central bank is essentially outright purchasing short-term bonds denominated in foreign currency. The central bank is obviously bearing currency risk. Second, very different motivation, or in a very different instrument, would be a central bank liquidity swap. So again, this is sort of a relative value motivation. We're trying to promote market functioning in funding markets essentially by reducing deviations from covered interest rate parity. And the mechanics here are essentially just making a short-term collateralized loan, which does not involve the central bank bearing any risk. Okay. So I think, outright purchases are clearly the right instrument to target the absolute level of yields. The question is, are outright purchases the right instrument to address Treasury market dysfunction? As I said, we typically think the dysfunction is due to a tightening of balance sheet and risk constraints at dealers. This resulting in a decline in Treasury liquidity and market dislocations. That said, large-scale asset purchases are not principally about taking pressure off of broker-dealers. Modern broker-dealers are essentially function as distribution pipes. The Wall Street adage would be they're in the moving business, not the storage business. So they're not kind of the frontline arbitrageurs. And in fact, we have very clear evidence that broker-dealers essentially bear minimal interest rate risk. Okay? So what are the right instruments to target Treasury market dysfunction? I'd argue essentially liquidity facilities, essentially making short-term collateralized loans that are essentially riskless are the right way. If it's pure market dysfunction, you should be able to address it with a liquidity facility. One source of dysfunction that was important during COVID-19 was Treasury sales by foreign central banks. These are central banks who wanted US dollar reserves but didn't want long-term treasuries anymore. Here we could have the, I forget what it stands for, FEMA repo facility, the backstop repo facility that allows foreign central banks to borrow using their treasuries. And essentially the idea here is we're reducing these kind of needless liquidations. That's relieving pressure on broker-dealer pipes and avoiding an unwanted jump also in term premium. The second source of dysfunction would be unwinds of treasuries, treasury versus derivative trades. So kind of by way of background, lots of end investors think insurers, pension funds, they want exposure to kind of long-term bonds, but they want it off balance sheet, either via futures or via swaps. There's a group of hedge funds who essentially accommodate this demand. They're going long treasuries and short these derivatives, but they're highly leveraged, and after a shock, they need to unwind those trades, and they end up selling them off to dealers who are suddenly now in this long-short trade. That's tightening dealers' constraints and leading to this decline in market functioning. Essentially, one way we could improve market functioning would be to take the pressure off of dealers. The Fed could essentially buy those treasuries from dealers and hedge the associated interest rate risk by selling derivatives. The Fed does not need to bear any interest rate risk here, and there essentially would be an almost perfect analogy with the logic of a central bank liquidity swap. So the kind of final thing would be essentially a proposal about how one could think about addressing future bouts of Treasury market function. First, elastically deploy liquidity facilities to support market functioning. These would follow sort of a Bagehot-like dictum and do not require the Fed to take on any additional interest rate risk. Only resort to outright purchases if there still are significant liquidations that are leading to a real incipient rise in term premium that's undesired. We're approaching the lower bound, and essentially the only way we can deliver monetary accommodation would be through outright purchases. All right, so conclusion, in terms of forward guidance, think about ways to strike a better balance between commitment and flexibility. We've learned a lot about how LSAPs work, but a lot we don't know. given the uncertainty about how things work, probably spend a little bit less time thinking about the transmission from LSAPs to financial conditions and more about the second link of the chain from financial conditions to financial quantities. And then third, be much clearer on the different goals for LSAPs and kind of have a lean towards a bias that liquidity facilities are the right tool for supporting market functioning. Thank you.
Thank you very much. One question over here. One over here. Please go ahead.
Thank you. Krishna Guha with Evercore Partners. I just wanted to strike a little note of caution about sort of steps under consideration that might weaken the efficacy of forward guidance in a future ELB episode. You know, we're looking to move away from an FAIT framework to something perhaps that's more like the old flexible inflation targeting regime, but of course that reintroduces the time inconsistency problems with overshooting, as Silvana noted in her presentation. We're also seeing good reasons to detach QE from forward guidance to a greater extent. But that takes away the skin in the game element and a very practical guarantee to market participants that the central bank can't adjust the interest rate very rapidly without the prior action on QE. Now, I understand that, you know, the idea that we could in principle just do the guidance itself correctly and completely on a standalone basis, but you can never write the complete contract, given all the things that might influence the outlook and the risks. And we want to strengthen the knockout clauses. And we also want to position them in forecast space, which is subject to central bank judgments, not in outcome space. Now, I'm very open to the idea, indeed I suspect it is true, that the cost-benefit balance might move in that direction. But there are costs here. And I wondered if there's anything in the research that can help sort of really illuminate how large are these costs in terms of efficacy? How might they affect, for instance, the credibility of guidance, the range or horizon over which we can provide guidance, and the effectiveness of guidance not just on the risk-free rates, but on risk premia and risk-taking? Thank you.
It's me. Thank you. Jing Yang from Bank of Canada. I have a question. Thank you very much for the presentation, Silvana. I have a question about the link between QE and balance sheet losses. I was very curious when you said if QE is successful, it should lead to balance sheet losses because it lifts the economy out of ELB. I would have thought the link between the two doesn't have to be there. If you look at QE post-Great Financial Crisis, that has not led to balance sheet losses. It's quite the contrary. We all had a balance sheet gains in most of the central bank have done QE. The reason we had balance sheet losses this time is because the rapid increase in interest rate, which caused by inflation surge. Thus, I think for central bank to lift the economy out of ELB, that does not necessarily have to link with the inflation surge, that's balance sheet losses. I'm just curious about your response. Thank you.
You have some question about the after effects of QE, in a sense that when you do QE, you take, of course, duration risk out of the private sector. And subsequently, when you want to slow down the economy, you have to move much more aggressively on the interest rate. And would you agree the fact that the Fed moved so aggressively subsequently without triggering a recession was because QE moved a lot of duration risk out of the financial sector? And generally, I would like to know what have you thought about the optimal Fed balance sheet size in this context? What should we do forward? Is there an optimal size on this, or perhaps this goes beyond the task you were assigned to? Thanks a lot. Great presentation and great discussion.
There we are. Okay. Thank you. These are great questions. Let me start with Krishna. You said we wanted to detach QE from forward guidance. No, forward guidance is about guidance on the rates, guidance on the purchases, asset purchases. So we don't want to detach them. wanted to detach, to the extent that is possible, is the interest rates from asset purchases, so that you effectively have these two tools that you can use, not necessarily fully aligned. Otherwise, I mean, if they're... So there's the other aspect that you mentioned, that, you know, by having more flexibility in your forward guidance, you might lose some of the effectiveness. And again, it's trade-off territory. And this is why we suggest do the scenario analysis. It might be that doing that scenario analysis, the Fed decides, well, we actually want to go for the high effectiveness, and we want to discount, the flexibility to exit, and that's fine. But, you want to do that and be aware of the costs and risks you are undertaking by following that particular guidance. So that's all. It might be that, again, if we rewind, the Fed would have still, taken the same decisions, and that's fine. It's trade-off territory, and there's a judgment on how to, how much weight you put on those costs and risks. So, on Jing, so I made the point that, and maybe it's consistent with what you're saying, if you are doing asset purchases for financial stability purposes, you will likely be buying bonds when the spreads are very high. And so, once you unwind these policies, you're making, big gains in your balance sheet. And maybe that's what happened, with the financial crisis. And that's why central banks were not making losses at the time. But then, if you think about the just doing QE or asset purchases for monetary policy purposes, and you are getting the economy out of the ELB, you actually will make losses in your balance sheet. So making just that discussion. Now, I also want to emphasize that these balance sheets losses in the big scheme might be very small compared to the broader macroeconomic benefits of taking the economy out of a crisis or out of a deep recession. So that's the perspective that one can gain by having a framework with this costs and benefits analysis embedded in it. Marcos, my jet lag is, not helping me. But your final question was, you asked a couple. Let me go for the second that I remember. You asked about the size of the balance sheet and the optimal size of a balance sheet, and that should be primarily a financial stability consideration. And as a central bank, you want to make sure that you cover the liquidity needs of the financial systems in normal times, and so you want to, ask banks and non-banks, how much liquidity they would need, and you also need to have a precautionary amount of reserves, to deal with a crisis, because that's an important part of the central bank's function. That might be harder to assess, and there will be judgment on there, how much precautionary what's the precautionary size of the balance sheet. And then there would be, speculative demand for reserves bearing with the interest rate. So you need to have these three elements. And again, perhaps the first one, related to the micro-proof function, should be easier to gauge from, just asking banks directly. The precautionary is, will depend on your stress tests and what are the risks you're considering. I see it more as a financial stability issue. From the monetary policy perspective, I don't think there is any constraint there.
Let's do another round of questions. Alp has a question here, and then Ricardo over here.
Hi. Great presentation and discussion. Both of you emphasized that in terms of their macro stimulus, these policies work through financial conditions. And you have also both emphasized that the effect of these policies on financial conditions is highly uncertain and can change over time. I would think these two observations would naturally imply there might be benefits to make these policies contingent on financial conditions. In particular, the escape clause should probably include financial conditions. So if you start a QE program, say, to ease financial conditions to a particular level, if it doesn't ease enough, you want to increase the size of the program. Or initial easing mean reverse, you want to increase the size of the program. But if it eases too much relative to your intentions, you want to automatically slow down the size of the program or maybe start tapering. So I think this might give you better control over financial conditions, which seems to be the key channel by which these policies work.
I actually want to make a comment on Marcus's question. I understood it as a little differently. I understood it as saying, look, QE draws duration from the market, and therefore, during the recovery phase or when you want to tighten, you're not going to be very effective because you have reduced duration. But remember that it's happening in a context in which we had also massive fiscal expansion. So we have lots of injections of duration from some other places, which raises a more general issue whether you want to sort of consider the whole balance sheet of the private sector, not only the central banks.
That was the first question, and I only answered the first. Thank you, Ricardo.
Jen Abel, please.
Just a follow-up to Sam's observations about the Kash-Epstein, Wallen, and Younger proposal to use futures or swaps for the market functioning facilities. The point that Silvana initially raised was about distinguishing between market functioning interventions and QE. And this proposal does that by using a different instrument. But by doing that, using the different instrument, it goes further than distinguishing sort of from a messaging perspective, because it also doesn't put anything on the balance sheet, right? And so Sam pointed that out, but it's really going, the proposal does more than what was initially, what the mandate asked for. So I think it's important to keep those two things separately, because you could, in principle, accomplish the messaging distinction without using a different instrument.
Yeah, just on this point, I mean, I think it's a very interesting proposal, and has many aspects that are very promising. If the problem is basis trade, I think it's a very clever solution. I'm less sure that the financial crisis, the global financial crisis, was about basis trade. Probably, it was more of an issue during the COVID pandemic, and but it's definitely a very interesting proposal that. Would tackle this friction very well. I think Sam wanted to answer the other questions.
Yeah, so actually, so Jan, I completely agree. It's not just, their proposal is not just distinguishing. I think it's sort of taking that to the logical limit, and if you really do believe that there are these two different goals, it actually implies kind of a functional separation, that you can do improved market functioning. If it is market functioning, you should be able to do that without bearing risk. I do, I understand that setting up a facility that would be, shorting Treasury futures might be a bridge too far. But I think that that's kind of, but I think the idea that it can be done that way does speak to this kind of important. It's not just a distinct thing. It should actually logically require a different instrument. And yeah, that's kind of why I made this foreign exchange intervention versus liquidity swap. It's almost perfectly parallel. Alp, to your point on financial conditions, I mean, actually, there's been a recent literature, Tyler Muir, Valentin Haddad, and Alan Moriera have kind of a series of, and actually, Adi Jeremini and Eric Zwick had one as well, kind of making this point that to the extent that asset purchases themselves are responding to financial conditions, that kind of plays essentially kind of an automatic stabilizing role in markets. I think the way that the literature has seen it is that has not been made explicit, but the market certainly implicitly understands that if there's a severe unwanted tightening of financial conditions, that the Fed will probably try to ease financial conditions in some way. So I don't know if it needs to be made explicit. Yeah, I would be pretty uncomfortable with a trigger based on the Moody's, BBB spread or anything concrete, but my sense is there's already a significant implicit element of that.
Okay, one more round of questions. We had one question over here, please. And then one over here.
I'm Makoto Kasai from the Bank of Japan, and thank you for your thorough presentation. As you know, we have implemented various unconventional tools, but still we have a lot to learn. And I'm very curious or interested in your idea about the stress testing. And do you think the publishing the result of such a stress test will enhance the effectiveness of such tools, or do you think it should be kept internally?
Yeah, just to push a little bit on Christian, Jonathan Pengel, just asking, in terms of the Odyssean forward guidance, the desire for more flexibility, the and versus or, when we think about state contingent forward guidance, there is probably some power to that and the commitment, but isn't some of the flexibility really just addressed with the clear escape clause, say like the Evans rule, like, if it was and maximum employment and inflation above target, or inflation say over 2.5%, then we can proceed with liftoff. And I'm just curious, like how much of the concerns about not enough flexibility can be mitigated with an effective escape clause in state contingent forward guidance?
Oh, very interesting. All of the exposition was in terms of asset purchases, but we've been in a world of quantitative tightening. And I'm just wondering how we should think of that. Are things symmetric, or could there be some interesting asymmetries? And what I have in mind is, okay, we saw a rise in short-term rates. Bank portfolio securities holdings took a hit. Okay, that weakened them. So if we want to do, when doing tightening, you're selling more long-term securities on the market. So could there be some financial stability considerations on the tightening side?
All right, let's just have one from Bill English before we get a reply.
Thanks very much. I had a question for Silvana. You raised kind of the possibility that there should be in the framework some way of incorporating losses on QE into QE decisions or something like that. But I wasn't entirely sure what you had in mind, and anything more you could say on how that should be rolled into the framework would be very interesting.
Okay. So yeah, let me start with the first question. This stress testing, I'm thinking of it, done internally for the purposes of having a robust policy, a robust forward guidance or asset purchases. It's just thinking about, potential scenarios that might make the guidance, obsolete very quickly, or, you want to have that robust. But I'm not thinking about publishing this stress testing. It would be of limited interest for, the general public or even market participants, how you came up to that decision. I think it would just add more noise than help there. I think, again, on the escape clause, again, we're proposing having a clearly integrated escape clause that, could help with that flexibility. And again, you might lose some of the effectiveness we were talking about, but on the other hand, will give you that state contingency that will be helpful if you were to face a rapid change in environments. To Mark, I think we typically think about interventions for financial stability purposes as when markets are very dysfunctional or in stress, and ideally you do quantitative tightening slowly so that you don't disrupt those markets, and possibly, there is an asymmetry there, and having QT done, slowly and in the background, seems like a reasonable way to proceed. Bill, I don't suggest considering the losses in the framework. I'm just saying, having a framework in which, you can quantify them and contrast them with the other benefits would be helpful for transparency and to communicate, again, to Congress and to the public, this is the cost. fiscal side of it, and the very limited fiscal side because it doesn't include the gains in extra tax incomes, et cetera, but so at least we'll put the discussion that is happening outside central banks into context and into perspective, and then people can judge, these are the costs relative to these macroeconomic benefits. But I don't think it has to be part of the Fed's or the central bank consideration. Ideally, you don't want the central bank to be concerned with, the fiscal aspect of this. I mean, that's part of independence, and yeah, it's only to, inform the public about a discussion that is already happening outside and sometimes not in a helpful way.
Does anyone have any last burning questions?
I think so.
I was just going to say, Mark, I think to quantitative tightening, I think most of our theories suggest that these are our theories, suggest that it should be rather symmetric. The only kind of main difference would be to the extent that you believe that kind of, short-term demand curves in markets are steeper than long-term demand curves. When you're purchasing, it's unexpected. You're kind of catching the market off guards, and you're hitting that kind of steeper short-term demand curve. Whereas when you're selling, it's so slow that you're on the kind of flatter part of the curve. But I think also, the literature is just focused less on quantitative tightening because it would be like, doing a study on watching paint dry. There's just not. There's nothing that we could ever detect in asset prices to see. Yeah, you could be like, is there quantitative tightening today? You'd have no way of detecting it, sitting there at your Bloomberg terminal. So.
All right. Thank you very much.
Thank you.
Good morning. Pleasure to be with you all. We're here today to present our analysis of the current macroeconomic landscape and offer a data-driven recommendation for monetary policy. We will provide an overview of economic conditions and offer forecasts for future growth along with potential risks. Based on this analysis, we will aim to balance the Federal Reserve's dual mandate of price stability and maximum employment.
Now let's begin with an assessment of economic conditions and outlook, focusing on the recent moderation in growth trends. Real GDP grew at annual rate of 1.4% in the first half of 2025, slightly below the estimates of long-run potential near 1.8%. The first quarter saw a contraction of 0.6%, followed by a strong rebound in the second quarter of 3.8%. The hot second quarter was driven by resilient consumer spending and one-time drop in imports, which boosted net exports. Still, recent data suggests that consumer spending growth is moderating, while business confidence remains constrained by trade uncertainty.
Thanks, Valeria. The dollar has remained strong throughout this recent cycle, though recent weakening as a result of trade policy comes with several implications. The dollar's sell-off supports growth via export competitiveness, but feeds into inflation through higher import prices, putting upwards pressure on inflation due to the United States' negative trade balance.
Turning to consumers, the personal savings rate has declined to 4.6% year-over-year in August, down from nearly 5% earlier this year. This signals that households have a smaller buffer against surprise shocks.
It is also important to note that consumer loan delinquencies has increased slightly. The research from Boston Fed highlights that this recent increase in delinquencies disproportionately have impacted those with lower income, while businesses and higher income individuals remains relatively stable. Overall, the consumer balance sheets remain relatively healthy, supporting continued strong spending.
Over in the bond market, in 2022, the yield curve inverted, followed by a normalization last year driven by rising real long-term yields. The nature of the normalization and the lack of a recession thus far support a soft landing narrative and indicate market confidence in the Fed's inflation targeting.
In 2025, Fed continued its quantitative tightening. The most visible adjustment has been its RRP facility. Use has fallen close to zero as liquidity migrated back into the banking system and bank reserves stabilized. Financial conditions are still adjusting. However, financial system is now well equipped with abundant amount of reserve to support lending.
Now we'll examine inflationary conditions within the macroeconomy, highlighting continuing trends and shifting pressures. Headline PCE is held steady at 2.7%, showing little movement toward or away the Federal Reserve's 2% target. Core PCE has shown a bit more firmness, edging up to 2.9%. This stickiness indicates that inflationary pressures, especially outside food and energy, are proving harder to bring down. Supercore PCE sits at 2.7% as well. This indicates that inflationary pressures persist in core goods and services.
During the pandemic, consumers shifted their spending away from goods and towards services. Now, spending has begun to rebalance, with moderate disinflation continuing in services. Food and energy contributions to PCE have declined dramatically, while housing remains a stable and positive contributor to overall inflation, signaling a shift in inflationary drivers.
Reflecting the shift, services spending remains a significant contributor to headline PCE, but now core good is exerting additional inflationary pressure on top of it.
Housing inflation slightly moderated, up only 3.9% year over year versus 2.7% for overall PCE, isn't a key component of core PCE. While this time last year saw housing play a significant role in inflation's persistence, core goods and services now appear to be more salient in the Fed's battle against inflation.
Inflation expectations have eased, with one-year expectations at 3.2%, near their lowest since the 2022 peak. After initial tariff-related concerns, expectations have settled near 3% and have stayed there since early 2024. 1- and 3-year readings are now close, reflecting a return to pre-pandemic levels.
Now we'll discuss the state of the labor market, highlighting its resiliency in the face of higher rate and trade policy impact. Slower consumer spending in services sector is now driving businesses to hire more cautiously. Average job gain for the last 4 months now sits shy of 27,000, much less than 2024 average of 168,000 jobs. Notably, 22,000 jobs were added this August, with the biggest driver being social services and healthcare sector. The federal sector saw a reduction of 15,000 jobs, fueled by the widespread layoffs in the federal government.
And when considering the labor market, it is also important to note the large downward revisions of 911,000 jobs over the last 12 months. These revisions point to an unforeseen degree of slack in the labor market, as well as question the reliability of initial jobs data.
And Valeria, alongside softer payroll data, the unemployment rate in August inched up to 4.3%. That remains within what many consider a steady long-run range, yet it is the highest since November 2021.
John, while the headline rate is important, I believe we should look beyond it and consider other measures of unemployment. For example, the U6 unemployment rate, which includes marginally attached workers in the labor force, has risen more quickly than the headline rate, pointing to broader slack in the labor market.
The trends in labor force participation also show discrepancies across work groups. Despite the recent uptick in unemployment, the prime age labor force participation rate sits at 83.7%, exceeding its pre-pandemic level. This indicates that even amid signs of labor market cooling, core age labor supply remains resilient.
Well, while prime age labor force participation remains resilient, the narrative for non-prime age group is quite different. Participation among older workers has declined to 38.1%, continuing a gradual downward trend since the start of the pandemic. Meanwhile, the participation rate for 20 to 24 age group has slipped from 72.5% in March to 70.2% in August.
I agree with your point, Valeria. On top of that, the rate of hire dipped from 3.5% to 3.3% this July. With prime age LPR and long-term unemployment rising, this points to accelerated cooling in hiring. After September's FOMC meeting, the San Francisco Fed President Mayor Daly noted weaker entry-level placement and fewer junior job posting as signs of labor market slowdown. With quits and layoffs being relatively stabilized, this JOLTS data further supports the notion of labor market looseness.
Youngju, this looseness is reflected in the vacancy to unemployment ratio, which is currently 0.99. Looking backward, Blanchard noted in 2022 that vacancy peaks have historically been followed by sharp declines that outpace rises in unemployment. This has been the case for the last 8 quarters since a vacancy peak in March of 2022.
Now we'll examine more specific considerations and risks in the macroeconomy, deliberating the path of future rate decisions. I believe our policy stance should take into account the current supply and demand dynamics underpinning inflation. Currently, demand-driven inflation dominates headline PCE readings, while supply-driven contributions have steadily waned.
One perspective on the inflationary impact of tariffs comes from former Governor Kugler, who argued that tariffs pose upside risk to inflation, while Cleveland Fed President Beth Hammack noted that upside pressures to inflation remain, stressing the importance of continued restrictive monetary policy to bring down inflation.
John, I tend to align more with Governor Chris Waller, who emphasized that a totality of economic factors, including tariffs and high interest rates, that could have a bigger impact on unemployment than tariffs alone would on inflation. As such, an easing bias in monetary policy is warranted, as the risk on inflation from tariffs is outweighed by the risk of an increase in unemployment from business uncertainty.
So, while demand-driven inflation remains a significant contributor, the supply-side pressure continues to play a role as well. While I appreciate Governor Kugler's perspective, it is also important to recognize broader economic factors at work, such as elevated rate, tariff, and other supply-side constraints that continues to influence the inflationary pattern. Either way, I believe labor market side of the mandate deserve our attention as well. The beverage curve appears to be shifting back towards its pre-pandemic positions as distortions such as reduced job matching efficiency and labor reallocation fade. However, post-pandemic, the curve has been focused on its C portion.
And Yeonju, as Governor Waller noted in 2022, positioning on a steeper side of the curve allowed for disinflation without a sharp rise in unemployment. Indeed, inflation has declined from record highs, while unemployment has remained stable. More recently, though, the curve has flattened and moved closer to its inflection point, reducing the scope for further disinflation without stress in the labor market.
Agreed. As Chris Foote of the Boston Fed noted, while interest rates rose amid record high job vacancies, unemployment remained relatively stable, rising less than 1 percentage point after mid-2022. As the beverage curve flattens, further drops in the vacancy rate will result in larger increases in the unemployment rate. Perhaps the Phillips curve could provide some insights into how the labor market is affecting prices. I align with Greg Mankiw's view that it is mostly a theoretical tool, though understanding its shape remains useful in assessing current conditions.
Ben, I agree most with Olivier Blanchard and Ben Bernanke, who argue that pandemic-era inflation demonstrated a linear relationship between inflation and labor market tightness. And, if anything, former Fed Chair Janet Yellen's view that the curve has become quite flat is the best characterization.
Good point, John. I tend to align with Peter Hooper and former Governor Frederick Mishkin, whose evidence for a nonlinear Phillips curve was compelling during the pandemic. However, with supply pressures now eased, it is less relevant with the current environment.
Regardless, I believe the strength of the economy posing upside risk to inflation may be a greater relative threat to the Fed than a weakening labor market. For that reason, perhaps maintaining our current policy stance may be warranted. While real private fixed investment has remained steady over the past couple of years, investment in AI and data centers through IPP and equipment have soared over the past couple of years.
That's insightful, John. Echoing that, we've seen software and hardware investments continue to rise, more than 12% and 43% respectively year over year. Cutting interest rates could potentially cause the economy to overheat, putting upwards pressure on inflation.
Well, while AI investment has clearly contributed to recent GDP growth, there remains substantial uncertainty surrounding its ultimate impacts on labor productivity, both in terms of timing and magnitude. As Richmond Fed economist Andreas Hornstein noted, no matter how many anecdotes we have about AI applications, it must show up in the aggregate data and across the broader economy before it becomes meaningful for monetary policy. For example, I think two pieces of aggregate data to observe the effects of AI would be labor force participation and job gains. Both show how structural changes in productivity and labor supply feed into the economy's long-run growth potential and therefore into the neutral rate of interest. Consequently, I believe New York Fed President John Williams' observation that the low R-star era persists remains relevant. The same demographic forces that pushed R-star down following the global financial crisis, being aging populations and slowing labor force participation, are still in place. A rate cut would help bring policy back to a more neutral stance more quickly.
I agree with you, Ben. The private job gain has slowed down drastically. Since the upside risk to inflation from tariffs remains relatively limited, the restrictive monetary policy might not be the most relevant in this scenario. We should look to return to a neutral policy stance sooner rather than later.
But that depends on what a neutral policy stance is, Youngju. Estimates of R-star vary significantly. The Holston Laubach Williams model estimates it at 0.84%, whereas the Laubach-Williams and New York Fed's DSG model place it as high as 2% in the near future. No matter the estimates, consensus models indicate that R-star is higher now than it was pre-pandemic. Now, time for a policy recommendation.
Well, I vote 25 basis point cut. The balance of risk is now tilting more towards unemployment compared to inflation, but the labor market still remains in balance.
I agree with the 25 basis point cut, Valeria. Although the labor market is continuing to weaken, the unemployment rate is still relatively low by historical standards, despite how the last few years may have taught us otherwise.
I think the path of rates matters more than any single decision. I'll vote in accordance with my colleagues in favor of a 25 basis point cut, using forward guidance to signal the possibility of larger cuts in the future, while emphasizing our commitment to 2% inflation and our insensitivity to short-term declines in asset prices.
I also vote for a 25 basis point cut. We should continue to view maximum employment as an inclusive and broad-based goal.
I agree with the 25 basis point cut. I also believe that we should continue the pace of our balance sheet reductions, as the banking system still has ample reserves. I also believe we should stress that the path of rates is downward and remain that data dependent for each individual meeting. Thank you, and we look forward to your questions.
Thank you for your presentations and your analysis. We have seen monthly gains in jobs move sharply lower this year relative to last year's period, while at the same time, the unemployment rate has only moved up a bit. How are these observations consistent, and what are the implications for monetary policy?
That's a very interesting question that we've been considering. As you mentioned, we've seen a steep decline in job gains from now 27,000. Right now, we put the break-even level with the Dallas Fed of Tremukin in 2025 at around 30,000 jobs, which is a steep decline from 2023, which put it at 250,000 for that reason. As you mentioned, unemployment has only increased modestly in that period. We really see this as a lag between the two, and there's obviously some slack in the labor market contributing to the difference in the two metrics not correlating as much.
And as Chair Powell mentioned in the FOMC meeting press conference, we are seeing both shift in labor market demand and supply. I'll talk about the supply first. So we are seeing reduction in the immigration, and as well as we are seeing the deduction in the labor market participation, although the participation rate for the prime age group stays resilient. And then for demand side, we're seeing some cooling demand due to the business uncertainties and other macroeconomic factors surrounding it.
It's also important to consider how models such as the beverage curve could help explain some of these measurements that you've referred to. The beverage curve shifted outward following the pandemic, indicating that bargaining power was higher among workers and peaked in 2022 with V over U at 2. Downwards, it has evidence of downward trend since then and sits at 0.99, indicating less bargaining power, which also feeds into less job switching. One reason that could be an explanation for some of the facts that you pointed to.
Lastly, another factor we must consider is that the unemployment rate, especially the U3, is often criticized as a more lagging measure as opposed to more forward-looking measures such as the beverage curve, as employees are often the last thing employers do when cutting back on the hours worked is they'll lay off employees. So the unemployment rate can often lag behind other economic indicators regarding the labor market. So it's important to take the totality of labor market factors as well as supply and demand into account when assessing the state of the labor market.
Well, thank you. And just to re-up the second part of the question, and thank you for those very helpful answers. If there is a discrepancy between the monthly job gains numbers and the unemployment rate, what are the implications for monetary policy?
I think the greatest implication for monetary policy in that case is that since monthly job gains can often be a little more forward-looking than the unemployment rate, it means that we need to be very watchful and have maybe a downside bias or easing bias in monetary policy to ensure that the labor market doesn't worsen further and potentially reach a recession. And in light of our dual mandate of maximum employment and stable prices, it's our job at the Fed to make sure employment is as high as possible while also keeping the price level under control. And for that reason, we need to, in those cases, be very careful that the labor market does not weaken and that we don't see the unemployment rate eventually start to go up as job gains would continue to be low.
we also think it's important to note that there's been a lot of revisions in job gains recently. And so although we may see substantial job gains in the future, or maybe some downward trends recently, it's always important to stay data dependent and understand there are various trends within the labor market to pay attention to. As we referenced, the beverage curve is a great reason to believe that we can, even with lower vacancies, unemployment doesn't necessarily have to increase given the steeper trend of the beverage curve recently. And so for that reason, it's a totality of economic conditions beyond just that.
Thank you very much. I have a second question about financial conditions. So how should policymakers take into account signals from financial markets, such as stock valuations and credit spreads, when deciding about monetary policy? And a second question, if changes in financial markets have different implications for monetary policy and financial stability, how should policymakers weigh the trade-offs?
Well, it is important to note that while we have to monitor the financial conditions, especially the yield curve and treasury conditions at the Federal Reserve, it is our goal to achieve maximum employment and price stability of our dual mandate. And for that, we have to monitor all of the broad economic conditions, and that will affect the monetary policy.
That's a great point. When we think about economic conditions, it's no secret right now that there are very high valuations, especially with regards to technology companies and the status quo. We think that good, stable financial conditions are a byproduct of prudent monetary policy, and oftentimes balancing the dual mandate will often set expectations accordingly. With that being said, we're resilient to a short-term fall in asset prices, meaning that as long as we continue to see the hype in stock market prices continue to translate into free cash flow and ultimately revenues down the line, we continue to believe that there is still stability there.
It's also important to note the current state of financial conditions as evidenced by measures of Chicago's Financial Conditions Index and such as high yield spreads, as you alluded to. The Chicago Financial Conditions Index peaked in 2022 and has been on a downward path since, also indicating that conditions were never particularly tight this cycle. In addition to that, high yield spreads are currently within reasonable levels, indicating that there's excessive or an abundant amount of lending capacity and that borrowers are not particularly constrained. So that, in conjunction with the yield curve's reversion to an upward slope, also indicates market confidence in the Fed's inflation targeting. And there are other measures such as longer dated tip spreads, of which the August 10-year break-even was 2.3%, which all goes to show that financial conditions are not excessively tight and that the market participants are confident in our ability to command stable prices for the benefit of the American public.
As my colleagues were saying, our dual mandate regards price stability and maximum employment. But that being said, we do need to monitor financial markets for two main things. First, we need to make sure see any factors that will affect our dual mandate. And the second thing is that we need to make sure financial markets function and that we're able to implement our monetary policy. So that dives into the Fed balance sheet. We need to make sure reserves in the financial system are at an ample level so that the federal funds rate remains within the target range and doesn't go outside the range. So it's important that we monitor the effective federal funds rate in the market and other measures of repos to make sure that we're implementing a monetary policy. And if reserves are scarce, or too abundant, then we can therefore adjust our balance sheet to ensure reserves are in the right spot to maintain a healthy short-term lending market and effectively implement the federal funds rate. But at the same time, we don't necessarily need to have an impact on, say, the stock market or the longer-term bond market, because those aren't part of our mandate. And while we'd like them to be healthy, because that generally leads to a healthier economy, there will be sometimes market froth that isn't necessarily completely within our control that we don't need to react to.
All right, thank you very much for
Do
this.
you want to ask this?
Yeah, maybe we should make sure that you have a chance to respond to the second question. So there are different implications for monetary policy and financial stability that you noted that is both important for the mission of the Federal Reserve. How should monetary policy weigh those? think you partially answered that you think should not. Is there a trade-off between those two?
No, we don't think there is a trade-off between those two. We think that if we can maintain, both a healthy financial system and effectively implement our policy, we can maintain our dual mandate of price stability and maximum employment, and while also keeping, financial markets healthy and functioning and able to effectively implement our policy to promote our goals.
Great, thank you.
All right, so thank you. Let me come back to one point that you raised in your presentation concerning R-star, and there was a point that I was a little bit confused about. So you titled a slide, "Dovish stance, is the low R-star era over?" Can you dig into this a little bit more? So what is the use of R-star in the policy process? What are the main determinants of R-star in the past, and how you project this into the future?
Yeah, for sure. So R-star is the neutral rate of interest, and right now it really determines what the policy stance is in terms of an accommodative or restrictive policy. And so estimates of R-star, as we mentioned, the Holston-Laubach-Williams model puts it at 0.84 as the real rate, whereas the Laubach-Williams and New York Fed's model puts it close to 2%. Recent research from Ina Hajani at the Cleveland Fed detailed that the R-star trends are often due to things like labor force participation, as well as wage growth and productivity trends. And all of those things can contribute to how it's evolving over time. Recently, we've seen a decrease in overall labor force participation, which may have lowered our